Welcome to Financial Accounting, brought to you by Parkbench Tutors. In this short podcast we're going to look at accruals, and we will start by considering what we mean by accruals. So let's consider first of all, what is an accrual? Well, we know that profit is determined by revenue less expenses, so we can consider how much profit we've made. So how do we do this? Well, we have to look at time periods. We make profit within a certain time period. So what are the time periods for most companies? Well, annual accounts have to be prepared by all companies, and most will also prepare quarterly reports, and monthly reports will usually be prepared internally for management purposes. So we have three lots of time periods, and it's these time periods which relate to how we deal with accruals. Let's look at a few examples here of how we may or may not want to deal with certain transactions. So we have a catering firm, and our owner wants to impress the bank manager. She buys £1,000 worth of supplies, pays £500 in cash, and the remaining amount is purchased on credit, and she uses those supplies during the month. And during that month she has revenues amounting to £2,500, which she's collected. So how much profit has she made? Well, of course, the answer is going to depend on how she treats the expenses that she's got of the supplies. So if she tells the bank manager she's made £2,000 profit during the month, she's probably misleading him. For a start, she's not taken into account the £500 that she owes for supplies. She may also owe other amounts, such as rent for premises, or expenses to travel, or maybe other expenses. But obviously, the way it stands at the moment, she's actually misleading the bank manager. Let's consider a pizza company making frozen pizzas and selling these to fast food outlets, and they make their deliveries weekly. And during the last week of the financial year, they decide to ship out orders that are 3 times as big as normal, and they are operating on a sale or return basis. But they record the revenue from the sales as being the amount that they shipped out. And then during the first week of the following year, they accept back any returns that are unsold. So what's the pizza company trying to do? Well, of course, this can be misleading for a potential investor, because what it's trying to do at the end of the year is suggest that its revenues are higher than they actually are. Now let's consider another case here of Cindy Motorcycles. And on May the 1st she sells a motorcycle for cash. On May the 15th she sells another motorcycle on credit. But then on May the 30th she accepts money for a motorcycle that she's not going to supply until the end of the following month. And yet she records all 3 of these as sales for the month, treating this as income or revenue. Well, what's misleading about that? Well, what's misleading, of course, is that she hasn't actually supplied the 3rd motorcycle. And so the figure that she's got for income or for revenue is in fact incorrect. Now, why do some large corporations make misleading claims like this? Well, it did happen a few years ago, and the problem occurred when the stock market was rising very fast, and expectations were increased, and managers came under greater pressure to produce good results, and expectations for investors were raised. And that pressure to report good results resulted in actions similar to the examples that we've just given. And none of those examples are in fact good accounting. So the question that we have for financial reporting is, when is the revenue actually earned, and when are the expenses really incurred? And in accounting, of course, there is a need for a uniform approach, and that approach is in fact governed by general accounting principles. So what accounting does is that it uses a number of important concepts to ensure that the reporting reflects what is actually occurring. And it's these concepts which are referred to as the accrual accounting concepts. They relate to revenue recognition and matching of expenses. They relate to the adjusting entries needed for accruals, and the adjustments that again are going to be needed for a trial balance, and how these affect the preparation for financial statements. And we will look at these then in our coming videos. This ends our short introduction to accruals, brought to you by Parkbench Tutors and presented by David Hopcroft. For more information, visit parkbenchtutors.com. Thank you for watching and for listening.